Have you ever wondered how really smart people can lose absolute fortunes in the market? Well, today we're going to dig into one of the biggest, but also one of the most subtle dangers in all of finance. And it's this: the huge mistake of taking your financial cues from people who are playing a completely different game than you are. Just look at this number for a second. That's $14 trillion with a T. That is the combined household wealth that just evaporated during the dot-com and the housing bubbles. A truly mind-boggling amount of money. Just gone. Now, what if I told you that a massive chunk of that $14 trillion loss could be traced back to a single, really powerful, and widely misunderstood idea? Just one simple concept that most of us never even stop to think about. So, you gotta ask, why does this happen over and over again? It's easy to just chalk it up to greed, right? But honestly, that's too simple. The real reasons are way more interesting, and they start with a huge misunderstanding of how markets actually work. Okay, so let's get right to the heart of it. This is the core problem: the idea of one price for two very, very different games. So here's the myth that so many of us believe without even realizing it, that every stock, every house, every single asset has one single rational price that everyone should agree on. Well, let me tell you, that idea is completely and totally wrong. Let me give you a perfect example. How much is Google stock worth? Well, if you're a long-term investor, someone planning to hold it for 30 years, a rational price is based on what you think its earnings will be for decades to come. But what about a day trader? Their goal is to sell before lunch. For them, a rational price is just slightly more than what they think they can buy it for right now. They could not care less about what Google's earnings are going to be in the year 2050. And this is so important. When people have different goals and different timelines, a price that looks absolutely ridiculous to one person can make perfect sense to another. It's because they aren't even playing the same sport. So how does this one little misunderstanding lead to these gigantic destructive bubbles? It all happens when the act of long-term investing slowly gets replaced by short-term speculating. Just picture this. Let's travel back to the mid-2000s. You see a pretty normal two-bedroom house in Florida, and it's got a price tag of $700,000. Is that a crazy price? Well, it completely depends on who you are. For a family that actually wants to, live there for the next 10 years, that price is probably insane. It's almost impossible to justify based on their income. But for a house flipper, if the market is red hot and they think they can sell it for $720,000 in just 2 months, well then, $700,000 is a perfectly rational price. Their game is all about that short-term momentum. And that is the key. The flipper's logic has absolutely nothing to do with the long-term value of the house. Their entire calculation is based on just one thing: will the price be higher very, very soon? Bubbles form when the whole market gets taken over by these short-term players. The conversation shifts completely away from long-term value, and it becomes almost entirely about short-term momentum. Back in 1999, the average mutual fund was only holding a stock for about 8 months. The entire market was playing a short-term game. So, okay, let's bring this back. Why does any of this matter to you? Because the real danger, the trap that gets so many people, is when we as individuals start taking our signals from people who are playing a game we don't even understand. Get a load of this. This fact is absolutely wild. At the very peak of the dot-com bubble, Cisco's stock was priced so high that its valuation literally implied that the company would one day be bigger than the entire economy of the United States, an obvious, clear impossibility for anyone thinking long-term. And right here, this is the trap. That absurd price made some sense to a day trader who was just planning to sell it in an hour. But the disaster happened when the long-term investor, the person saving for retirement, saw all that frantic buying and thought, well, maybe they know something I don't. I guess I'd better buy too. And just like that, they started playing the day trader's game without even realizing it. And this trap is absolutely everywhere today. It's taking a stock tip from some pundit on TV without knowing their time horizon. It's copying an investment you saw a celebrity make without knowing their goals. Heck, it's even just seeing your neighbor's fancy new car and feeling like you need one too without seeing their salary or, their debt. We are constantly taking cues from other people's games. So what's the solution? How do you protect yourself from all this? Well, it's actually pretty simple, but that doesn't make it easy. You have to consciously and deliberately identify the financial game that you are playing. So here's how you do it. First, Just start to notice all the noise around you: the TV, social media, the chatter from your friends. Second, ask yourself the most important questions of all. What am I trying to do with my money, and over what period of time? Is this for a house in 5 years, or is this for retirement in 40? And finally, write it down. Create a simple mission statement for yourself. It could be something as simple as this. This statement, it becomes your filter. Because once you know your game, the price a day trader is paying for a stock just becomes irrelevant noise. The car your neighbor bought no longer has any power over you. The most important question you can ask is not, what is everyone else doing? It's, what game am I playing? Define that, and believe me, you've already won.